What does it look like when a superpower makes an offer and expects the answer to be yes? It doesn't look dramatic. It doesn't look chaotic. It looks routine. A call placed, a proposal delivered, a deadline implied, and then silence. 96 minutes later, that silence became the most expensive answer Washington did not expect. The offer was rejected, not negotiated, not delayed, rejected. And in that rejection was a message that traveled faster than any tariff, faster than any tweet, faster than any threat. Canada chooses sovereignty. The White House believed it was restoring control. After weeks of market instability triggered by escalating tariffs and the sudden mineral export freeze, Washington recalibrated. The language changed. The tone softened. What had been public confrontation shifted into what insiders described as a stabilization outreach. The proposal was simple on paper. Remove the mineral export restrictions. Restore the flow of nickel, lithium, cobalt, graphite, and rare earth elements into the United States. In exchange, the administration would suspend the latest round of aluminum and auto tariffs, a reset, a cooling off period, a chance to return to what officials called mutually beneficial cooperation. But the structure of the offer revealed something deeper. It assumed urgency existed on one side of the border. It assumed that the economic pain unfolding across American EV plants, battery facilities, and defense supply chains would create equal anxiety in Ottawa. It assumed that Canada needed the American market more than America needed Canadian minerals. That assumption had been the foundation of North American trade politics for decades. It was the invisible architecture beneath every negotiation, and it was about to be tested. The call reportedly came mid-morning. Senior officials on both sides connected through secure channels. The message from Washington carried familiar framing. The escalation had gone far enough. Markets were reacting. Voters were asking questions. Governors from industrial states were pressing for stability. This was an opportunity to de-escalate before structural damage became permanent. The subtext was clear. Accept the offer. Declare a diplomatic win and move forward. What Washington did not fully calculate was timing. The previous week had already reshaped Canada's strategic position. European and Asian delegations had arrived quietly in Ottawa. Emergency mineral supply talks were no longer speculative. Frameworks were being drafted. Replacement buyers were lining up not out of sympathy, but out of opportunity. The minerals had not disappeared from the global market. They had simply been redirected. Inside Canada's cabinet process, the conversation was not emotional. It was mathematical. Reinstating exports to the United States would stabilize American markets immediately. It would also restore the leverage Washington had only just realized it lacked. Keeping restrictions in place would intensify short-term volatility, but accelerate long-term diversification away from a single dominant customer. One path returned to dependency. The other path redefined it. 96 minutes after the proposal was formally delivered, the response was transmitted back to Washington. The language was brief. Canada would not reverse its export controls while economic coercion measures remained active. There would be no partial restoration, no phase re-entry, no symbolic shipments to ease market pressure. Sovereign policy decisions would not be negotiated under tariff threat. The speed of that rejection carried its own message. It signaled that the answer had been prepared before the offer was made. There was no scramble, no emergency debate, no visible hesitation. The decision was structural, not reactive. Canada had already chosen its direction. The American proposal arrived too late to change it. Markets responded before press secretaries could. American EV stocks dipped again. Battery suppliers issued revised production guidance. Analysts began using a phrase that had not appeared in forecast even 2 weeks earlier: strategic decoupling. The idea that North America operated as a seamless industrial unit was dissolving in real time. In Washington, frustration turned public. The president described the rejection as short-sighted. Advisors floated the possibility of invoking emergency powers to accelerate domestic mining projects. Yet geology does not respond to rhetoric. Permits do not become production overnight, and global buyers were already negotiating with Ottawa on timelines measured in years, not news cycles. The 96 minutes mattered because they revealed asymmetry. One side was attempting to restore a previous balance. The other side had already moved beyond it. This was no longer about tariffs or temporary trade leverage. It was about whether Canada would define its resources as instruments of partnership or instruments of policy. For decades, the expectation had been automatic alignment. That expectation was now unstable. The offer assumed continuity. The rejection announced change. And change, once declared, rarely reverses itself quickly. The confrontation between Trump and Carney was no longer rhetorical. It was structural. It was about who sets terms when the foundation of an industry rests on minerals embedded in another nation's soil. It was about whether economic integration guarantees compliance or whether sovereignty ultimately overrides convenience. 96 minutes after Washington extended a hand, shaped by urgency, Ottawa closed the door, shaped by calculation. The signal was unmistakable. This was not a pause. This was a pivot. And the consequences were only beginning to unfold. Washington's mistake was not the offer itself. Governments make offers during standoffs all the time. The mistake was believing the clock was Canada's enemy. Inside the White House, the political math looked urgent. EV plants in Michigan were slowing shifts. A battery facility in Georgia announced temporary layoffs. Governors were calling. Cable news panels were asking whether the tariff strategy had triggered unintended damage. The administration believed pressure was building north of the border, too. After all, the United States was still Canada's largest trading partner. The American market absorbed massive volumes of Canadian exports. Surely Ottawa would feel the strain first. But what Washington read as mutual pressure was actually asymmetrical exposure. The American electric vehicle transition had been designed around scale. Gigafactories, battery hubs, assembly lines, all synchronized to a supply chain that assumed uninterrupted mineral flow: nickel from Ontario, lithium from Quebec, cobalt routed through Canadian processing facilities, rare earth elements refined in Saskatchewan. It was efficient, it was continental, and it was fragile. Canada's mineral sector, by contrast, was not dependent on one buyer. It was dependent on global demand. And global demand was expanding. Europe was racing to secure non-Chinese supply. South Korea and Japan were deep into industrial electrification strategies. Even emerging markets were positioning for battery manufacturing. The minerals in the ground did not expire. They waited. The question was never whether they would sell. The question was to whom. This is where the miscalculation hardened into strategy. After rejecting Washington's offer, Carney's government did not escalate rhetorically. There were no dramatic speeches, no personal attacks, no threats of further retaliation. Instead, Canadian trade officials accelerated negotiations already underway. Draft memorandums of understanding became formal frameworks. Delegations that had been exploratory became contractual. In Brussels, European Commission officials moved quickly. Access to stable mineral supply was not a bargaining chip. It was strategic insurance. German automakers, already uneasy about supply chain volatility, pressed their government to secure priority channels. In Seoul, Battery manufacturers evaluated Canadian nickel contracts as a hedge against future disruption. Tokyo signaled interest in rare earth cooperation tied to technology partnerships. None of these discussions were public, announcements at first. They were quiet shifts in trajectory, and that is what made them powerful. By the time Washington realized Canada was not waiting for the American market to reopen, Canada was already building alternatives. The speed mattered. Industrial supply chains operate on contracts measured in years. Once a manufacturer signs a multi-year mineral agreement with a new supplier, it does not pivot back easily. Capital investments follow supply certainty. Infrastructure aligns with contract duration. The longer Canada held its export controls in place, the more global buyers adjusted their logistics around new routes. Meanwhile, American EV producers were discovering the limits of substitution. Australia had lithium, yes, Indonesia had nickel, but processing capacity, transport logistics, and geopolitical risk all complicated immediate replacement. Redirecting supply chains across oceans added cost and time was the one variable Washington could not accelerate. The president responded, publicly, framing Canada's stance as self-harm. He argued that cutting off the American market would shrink Canadian revenues, but market data suggested something different. Global mineral prices began to rise as buyers anticipated longer-term realignment. Canadian producers facing diversified demand were not collapsing. They were repricing. This was not a sudden economic shock north of the border. It was a strategic recalibration inside Canada. Political reaction was strikingly unified. Opposition leaders, who had criticized Carney on domestic issues, stopped short of condemning the export freeze. Provincial premiers, particularly in resource-rich regions, saw leverage rather than liability. The message resonated across party lines. Canada would not negotiate under pressure. That unity sent another signal to Washington. There would be no internal fracture to exploit, no rapid political backlash forcing Ottawa back to the table. The assumption that economic strain would divide Canadian leadership proved inaccurate. The confrontation between Trump and Carney was now defined by tempo. Trump moved through announcement, escalation, offer, and public response within days. Carney moved through preparation, execution, redirection, and consolidation. One strategy relied on speed of pressure. The other relied on depth of planning. 96 minutes had revealed the answer to the offer. The weeks that followed revealed the larger truth. Canada was not improvising. It had anticipated the standoff and built a runway beyond it. And as global contracts shifted and factories recalculated timelines, a deeper realization began forming inside American industry. This was not a temporary dispute waiting for a handshake. This was a structural shift in who controlled the starting point of the 21st century economy. Every trade war eventually collides with reality, not political reality, not polling data, physical reality. Steel can be redirected, cars can be rerouted. But minerals are different. They are not manufactured, they are extracted. And extraction obeys geology, not negotiation. As the standoff deepened, American officials began to confront a truth that had been buried beneath decades of economic integration. The United States did not simply import Canadian minerals out of convenience. It imported them out of necessity. The American clean energy transition had been built like a skyscraper on a foundation poured across the border. Nickel for high-density batteries, lithium for energy storage, cobalt for stability, graphite for anodes, rare earth elements for motors, magnets, defense systems, and advanced electronics. Each component was part of a chain. Remove one link, and the chain does not bend. It snaps. At first, the White House response focused on acceleration. Permits would be fast-tracked. Domestic mining would be expanded. Emergency authorities would be reviewed. The Defense Production Act was mentioned again. But mining projects are not factories that can be turned on with a signature. They require environmental assessments, infrastructure development, capital investment, community, negotiations, and years of extraction planning. Industry experts began speaking more openly, even with emergency measures. It would take a decade to meaningfully reduce dependency. A decade in which competitors abroad were already securing long-term contracts with Ottawa. That is when the tone shifted. Behind closed doors, defense analysts started raising alarms. The mineral freeze was not just disrupting EV plants, it was intersecting with military supply chains. Modern fighter jets rely on specialized alloys. Missile guidance systems require rare earth magnets. Naval vessels incorporate nickel-intensive steel compositions. Satellite components depend on materials now subject to Canadian export control. The United States had spent years attempting to reduce strategic vulnerability to distant adversaries. Now it faced a vulnerability closer to home, created not by hostility, but by diplomatic breakdown. In response, Trump escalated rhetoric again. He framed Canada's decision as hostile. He warned of consequences. He hinted at further tariffs and countermeasures. But each threat collided with a question that markets were already asking. What leverage remained? Tariffs on finished goods had already been deployed. Aluminum and auto duties had triggered the initial confrontation. Additional tariffs risked deepening recession fears in both economies. Energy restrictions were floated in online commentary. But both countries understood the mutual risk of energy escalation. The economic interdependence that once ensured stability now limited escalation options. Meanwhile, Canada continued moving without spectacle. New mineral corridors were announced quietly. Infrastructure funding for westbound export terminals accelerated. Rail capacity expansions were approved to move material toward Pacific ports. Atlantic shipping routes were reviewed for increased European demand. None of this made dramatic headlines, but collectively it marked a pivot. The longer the freeze held, the more global supply maps began redrawing themselves. American automakers attempted adaptation. Some shifted production schedules. Others scaled back EV targets for the next 2 model years. Investors recalculated earnings forecasts. What had been an ambitious acceleration toward electrification now looked like a slowed transition with rising input costs. On financial news networks, analysts started using a phrase that had rarely appeared in discussions about Canada before: resource sovereignty. It was not framed as aggression, it was framed as leverage, and that word leverage reframed the confrontation entirely. For decades, the assumption had been that economic size determined dominance. The United States, with its massive GDP and consumer market, was presumed to hold structural advantage. But leverage does not always flow from size. It flows from bottlenecks, and critical minerals were the bottleneck of the modern economy. Carney's strategy rested on that bottleneck. He did not need to match American economic scale. He needed to control a narrow essential input that could not be easily replaced. The export freeze was not a permanent embargo against the world. It was conditional. It targeted economic coercion. It signaled that partnership required respect. Inside Canada, public opinion hardened in support. Citizens who had rarely considered the geopolitical importance of nickel deposits or lithium reserves began to understand their strategic weight. The minerals were no longer abstract commodities. They were instruments of national agency. Trump, meanwhile, faced a narrowing set of choices. Escalation risked deeper industrial slowdown. Concession risk political backlash at home. Waiting risk further global redirection of supply contracts. The offer that had been rejected in 96 minutes now looked like a missed off-ramp, and the markets understood something before politicians did. This was not about winning a news cycle. It was about who would define the rules of industrial power in the coming decade. The confrontation between Trump and Carney had moved beyond tariffs. It had moved beyond speeches. It had entered the realm of structural economics, where decisions echo for years. Beneath the headlines, beneath the rhetoric, beneath the diplomatic exchanges, there was a simpler truth. The ground beneath Canada had not moved, but the balance of power built upon it had. Trade wars are often described as battles of endurance. The assumption is simple. The larger economy can outlast the smaller one. The bigger market can apply pressure until the other side bends. But endurance depends on structure. And structure determines who actually feels the weight of time. As weeks passed without reversal, a quiet realization began spreading across American industry. The freeze was not cracking, it was settling in. Automakers adjusted forecasts again. EV rollout timelines were pushed back quarter by quarter. Battery manufacturers issued revised guidance citing input instability. Investors started asking whether the United States had overpromised on electrification targets built on fragile supply assumptions. Federal incentives remained in place, but incentives cannot manufacture minerals. The White House continued public messaging. Officials argued that domestic production would ramp up, that alternative sources would fill the gap, that Canada would eventually return to the table. But markets were not trading on speeches anymore. They were trading on contracts, and contracts were shifting. European firms finalized multi-year agreements with Canadian suppliers. Asian battery manufacturers secured guaranteed nickel volumes tied to joint processing investments. Infrastructure money flowed toward Canadian ports, positioned for transatlantic and trans-Pacific exports. What had once been north-south chains were now bending east and west. The longer this continued, the more the clock favored Ottawa, because industrial realignment compounds. Once factories recalibrate around new inputs, once logistics networks restructure, once capital expenditures are redirected, inertia builds. Reversing that inertia requires not just diplomacy, but trust. And trust had been fractured. Inside Washington, political pressure intensified. Governors from manufacturing states grew more vocal. They were not speaking in ideological terms. They were speaking in employment numbers. Assembly lines that slow down create headlines at home. Workers sent home indefinitely create questions that cannot be answered with strategic theory. Some lawmakers began urging negotiation without preconditions. Others doubled down, warning that backing off would signal weakness. The divide was not just partisan, it was structural. Industrial states felt the disruption immediately. States less tied to manufacturing viewed the standoff as leverage still worth testing. Trump's messaging remained combative. He framed Canada's move as overreach. He emphasized American resilience. He highlighted domestic resource potential. But beneath that rhetoric was a narrowing tactical field. Escalation options carried risk. De-escalation carried political cost. Meanwhile, Carney maintained restraint. There were no victory laps, no grand speeches declaring triumph. His tone remained technical, almost clinical. Canada would continue exporting minerals to partners who did not impose coercive trade measures. The policy was consistent. The conditions were transparent. The door was not locked forever. It was locked until respect was restored. That framing mattered. It prevented the dispute from becoming emotional. It anchored the decision in principle rather than personality. and it made reversal conditional, not humiliating. If tariffs were lifted, exports could resume. If pressure ended, partnership could return. The burden of choice remained in Washington's hands. Time in this structure was not neutral. Every month of delay slowed American EV momentum. Every month diversified Canadian customer portfolios. Every month hardened global perception that Canada was willing to act decisively when challenged. Defense analysts continued warning quietly. Military procurement timelines could not absorb prolonged mineral instability without cost. Contingency sourcing plans were drafted, but alternatives were expensive and limited. The idea that the closest ally could become a supply vulnerability unsettled strategic planners. Yet Ottawa did not frame the situation as punishment. It framed it as policy. Sovereign states control their resources. Sovereign states decide how and where those resources flow. Sovereign states respond when pressured. The narrative difference was subtle but powerful. Trump spoke of winning. Carney spoke of terms. Winning is temporary. Terms are structural. As financial quarters rolled forward, Wall Street adjusted expectations. EV growth projections moderated. Clean energy acceleration scenarios were revised downward. Analysts began openly modeling a multi-year lag in American electrification relative to Europe and Asia if mineral access remained constrained. That modeling created a new layer of pressure, not from politics, but from competition. Because this was never just a bilateral dispute, it was a race to define who leads the next industrial era. If American factories stalled while European and Asian facilities accelerated with Canadian inputs, the cost would not just be economic, it would be strategic. And that is when the deeper question surfaced. Was this confrontation about pride, or was it about architecture? The architecture of North American industry had assumed automatic alignment. The freeze revealed that alignment required mutual respect. Without it, the architecture cracked. The clock kept ticking. But it was not ticking equally. For the United States, each passing week carried industrial drag. For Canada, each passing week expanded optionality. Endurance, it turned out, was not about size. It was about position. And position in this confrontation was defined by what lay beneath Canadian soil.